The first half of 2017 has been very kind to stock investors, which leads many people to ask us, why are stocks doing so well? And are stock prices too high? Let's take the easy question first. This has not been a Trump-induced rally as many have been led to believe. Instead, this has simply been an earnings-driven rally. First quarter 2017 earnings for the S&P 500 index grew nearly 13%. It should then come as no surprise the S&P 500 index was up 9% in the first half of the year, with the tech-heavy NASDAQ doing the best, gaining 14%. International shares have finally come to life and were also up 14% in the first half of the year. Now for the tough question. Are stock prices too high? By virtually any measure, stocks are definitely not cheap, but we also believe stocks are not overvalued either. This fully valued scenario means there is little room for error, and for stock prices to move higher, we need the following to occur. Companies need to produce respectable second quarter earnings results. With expectations high, it will be important companies meet or beat estimates. Solid economic data in the United States and abroad is needed to support the idea the global economy is continuing to grow. And lastly, any tax cuts or infrastructure spending will be welcomed by investors and will help propel stocks upward. Failure to pass legislation won't have a material impact on stocks as expectations for progress out of Washington have been greatly reduced. The press has been making a big deal out of the flattening of the yield curve and how this is an omen for bad things to come. For starters, what does it mean to have a flattening of the yield curve? To put it simply, this occurs when long-term interest rates decline while short-term rates go up. If this phenomenon lasts long enough, investors get worried that the long-term prospects for growth are in jeopardy. While keeping a close eye on the flattening of the yield curve is justified, we believe the trend will reverse itself in the second half of the year as growth will accelerate and long-term interest rates will rise in response. As you can probably tell, we are optimistic the second half of 2017 will be solid and stock prices will be even higher at the end of the year. That being said, markets are long overdue for a 3 to 5% correction, but we believe any such correction will be short-lived as buyers have been quick to step in at every opportunity. In short, don't let headlines about the president or the economy shake your confidence and instead focus on corporate earnings. From the HM Capital Management team, thank you for watching.